Welcome back. In today's explainer, we are running a complete financial diagnostic on CVB Financial, ticker symbols CVBF. We're going to totally bypass all that noisy market sentiment and just dive straight into the raw data together. We'll diagnose the patient step by step to see exactly what's going on under the hood. Let's get into it. Okay, let's dive into this. Here's our game plan. First, CVBF at a glance. Then, a growth and profitability check. Number 3, decoding those valuation ratios. 4, dividends and income potential. And finally, fair value and safety. So, part 1, CVBF at a glance. Let's check those basic vitals. To really ground our analysis here, let's start with a big number, $3.448 billion. That is CVBF's current market cap. So right off the bat, we know this isn't some tiny, volatile microcap, right? This is a massive, multi-billion-dollar financial asset. And as of its last close, the market was pricing individual shares at exactly $19.54. Keeping this massive scale in mind is absolutely crucial as we start analyzing the cash this machine actually generates. But when we look at how that stock price has actually performed, we immediately run into a bit of a mystery. Think about this. If you held CVBF for the last year, your total return was an incredibly modest 1.94%, barely moving at all. If you pan out to 5 years, your total return drops back down to a pretty lackluster 6.30%. But right in the middle, the 3-year total return is a massive 93.72%. No way, right? This extreme volatility in historical returns really begs a huge question. What exactly is happening to the underlying business that's causing this kind of turbulence? Which brings us to Section 2, our growth and profitability check. Time to look under the hood. So to solve the mystery of those wild returns, we really have to look at the cash. Over the trailing 12 months, CVBF pulled in nearly $648.5 million in revenue. That's growing at a rate of 4.71% over the last 3 years. But here's the rub. Net income is sitting at about $208 million, and it's actually shrinking by 3.84%. And honestly, worse still, free cash flow, which is literally the lifeblood of any business, is contracting at a rate of negative 6.77%. Guys, this is a critical warning sign. The bank is bringing in more top-line revenue, sure, but less and less of it is surviving the journey to the bottom line as actual spendable cash. However, we definitely need to keep things in perspective here. Despite those negative growth trends in net income and cash flow we just saw, CVBF is by no means a broken business, not at all. They still maintain a remarkably robust net profit margin of 30.70%. Basically, for every dollar that comes in the door, they're keeping over 30 cents in pure profit. On top of that, their return on equity sits at 9.06, and their return on assets is 1.35. So the real diagnosis here, we've got a highly profitable machine. It's just currently struggling a bit to find that bottom line growth. Moving on to Section 3, decoding the valuation ratios. Let's talk about pricing the asset. So you might be wondering, what kind of price tag is the market actually putting on these profit margins? Well, what's really interesting about this data is we aren't getting a discount at all. When we compare current valuation ratios to their 3-year averages, almost everything is trading at a premium. The price-to-earnings ratio sits at 12.94. That's nearly 5% higher than its recent historical average. The price-to-sales ratio? Up a massive 33%. And price-to-free cash flow is trading at 12.19, which is almost 10% higher than average. Basically, the market is asking you to pay a premium for CVBF today compared to what it was asking over the last 3 years. But honestly, it's the PEG ratio, which measures price-to-earnings relative to growth, that should really make you sit up and pay attention. Right now, the current PEG ratio is 2.66. Compare that to the 3-year average PEG ratio of just 0.66. That is a massive 303.89% spike. So what does this mean in plain English? Well, it means you're currently paying significantly more for significantly less growth than you were over the last 3 years. All right, Section 4, dividends and income potential. Is the cash flow reliable? Look, if we're going to be paying a premium, we absolutely need reliable income. And the profile here, it's actually quite compelling. The current dividend yield is a very healthy 4.09%. But more importantly, the payout ratio is sitting comfortably at 52.98%. This tells us the company is only using about half of its earnings to cover the dividend. That means that 4% yield is highly protected. It's very safe. And over the last 5 years, they've even managed to grow that dividend at a compound annual rate of 2.13%. But wait, there is a bit of a catch hiding in the data. CVBF currently has exactly 0 consecutive yearly dividend increases. Zero. So while the yield is high, and yes, the yield is safe, management just hasn't consistently raised it year over year recently. The takeaway here? If you buy this for income, you're locking in a really solid yield, for sure, but you shouldn't necessarily expect a pay raise every single year. And finally, Section 5, Fair Value and Safety. Let's find out, is it actually on sale? So, after checking all the vitals and the income, it is time for the ultimate prognosis. For this, we rely heavily on the margin of safety. Just as a quick refresher, this is simply the percentage buffer between CVBF's current market price, which we know is 1954, and its intrinsic calculated fair value price, which our data models at 2268. Naturally, the larger that percentage buffer is, the safer the investment. Why? Because you're basically buying the asset for less than its actual mathematical worth. It's your safety net. Now, when we actually run the numbers, we get this incredibly fascinating split. The blended overall margin of safety for CVBF sits at 13.86%. So it's undervalued, but, not by a massive margin. However, if we isolate our valuation purely for free cash flow, meaning we calculate fair value strictly based on the cold, hard cash the business generates, the stock looks significantly cheaper. We're talking a massive 37.89% margin of safety. It's wild because despite cash flow shrinking a bit recently, the absolute amount of cash they produce is still incredibly strong relative to that current $19 share price. So the whole shebang really comes down to this data-driven fair value price, $22.68. With the stock currently trading at $19.54, the math is loudly suggesting that CVBF is trading at a discount right now. To sum it up, it's a highly profitable bank with a safe 4% dividend. That holds true even if its bottom line growth has kind of stalled out, and even if its valuation multiples are looking a little stretched compared to recent history. Which leaves us with the ultimate question. With a blended 13% margin of safety and a rock-solid 4% dividend yield, is CVBF's price right for your specific portfolio strategy? The data shows us a highly profitable, income-generating asset that is definitely struggling with growth, yet somehow it's still trading below its intrinsic fair value. I really encourage you to take this diagnostic framework and apply it to your own investing decisions going forward. Thanks so much for joining me on this explainer, and keep learning.